That is the closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. And Yahoo Finance's Allie Canal joining us here to break down the moves today. Allie, what are you seeing at that close?
I'm seeing a lot of records here, Josh. We have new records and all-time closing highs for the Dow, Nasdaq, S&P, even the small cap Russell 2000 securing a fresh high here. Now the Nasdaq leading the way higher. We are off of the session highs just a bit, but still up 0.9%. S&P up 0.5%, and the Dow up roughly 0.3%, or just around 120 points. Also interesting to see that the equal weighted index for the S&P 500 outperforming the benchmark index just slightly. This shows it wasn't all about tech, that this rally has extended beyond some of those mega cap tech names, but tech certainly didn't hurt, helping boost the Nasdaq. A lot of this came after Nvidia unveiled a $5 billion investment into shares of Intel. You're seeing Intel top of the trending ticker page on Yahoo Finance, finishing the day up 23%. I believe Nvidia closed just around 3% higher here. But if we take a look at some of the sector action where we finish things off, you're going to see most sectors in the green. We have tech, we have industrials, financials, even healthcare is up there in the green. And then on the downside here, we have consumer discretionary and consumer staples rounding things out. And then I finally want to get a check on Bitcoin. This is something that we've been tracking, the crypto market in general, because we do seem to have more of a boost here after those Fed rate cuts. Crypto is trading just around $118,000 a coin. This has been branded as a key technical level to watch. Really, you want to watch that $120,000 level. Bitcoin has really struggled to get past this right here. We saw those highs earlier this summer. We'll see if we can get there. This is certainly a good upward momentum, solid trends. Year to date, we are up nearly 25%, Josh.
All right, Allie, thank you. Well, the Fed's latest cuts may have investors more optimistic, but with labor markets showing signs of cracking and sticky inflation, is it time to reposition portfolios? Emily Rowland, co-chief investment strategist at Manulife John Hancock, joins us now to discuss. Emily, great to see you as always. I want to start, Emily, by getting your response and reaction to that Fed decision. What'd you make of that decision? And what do you make, Emily, of the market's response to that decision?
Yeah, it was pretty tough to figure out which direction the markets were going in. We got the decision to lower rates by 25 basis points. The statement read relatively dovish, and you saw risk assets rallying and bond yields falling. But then came the press conference, and we know that the first reaction in markets isn't always the right one. And we read Powell as a bit hawkish here. He talked about the risk management cut. Basically, that was an indication that he wasn't going to commit or promise to any more cuts. It was a reaction to some weakening in the labor market. And then Powell talked about the fact that there really wasn't any support for a 50 basis point cut at the meeting. So we saw, again, bond yields backing up on that a bit. We saw small caps, which you just talked about, were almost up about 2% on the day. Those ended the day in negative territory. So a bit of a merry-go-round as it relates to the response to that Fed meeting yesterday.
How many cuts, Emily, would you pencil in going forward? What do you think the pace looks like? And does the market, does it depend on cuts, Emily, to move higher?
I mean, it's just amazing to see. The market pretty much has selective hearing right now, and all it's hearing is Fed cuts, which are great news for risk assets. It almost feels like bad news is good news and good news is good news, because all of it means that the Fed here is going to continue cutting. And we do think that the dot plot makes sense for the Fed to cut twice more, 25 basis point increments at the next two meetings, because there is some pretty significant weakening in the labor market. It's weak enough that the Fed should cut here, but inflation hasn't is still stuck at elevated levels, which means the Fed needs to be careful about being too aggressive in cutting. The markets are looking at this like we're in a sort of a honeymoon period where the labor market's deteriorating enough that the Fed can loosen monetary policy or financial conditions, but it's not so weak that the Fed can't get us out of it with those rate cuts. So certainly a risk on response, and we're seeing that in new all-time highs, small cap surging. Again, this is very bullish for risk assets.
Let me ask you, Emily, the Fed cuts, but what do you make of the response in the benchmark 10-year with yields moving higher? What's that telling us?
Yeah, today that was really a good news, I think, response to the economic data. The Philly Fed index came out and handily beat expectations. The new order component, which is something that we watch across all of these business surveys, surged. We saw initial claims coming down. Everybody was a bit spooked last week when we saw that jump in initial claims. Of course, it was a sign to the floods in Texas and fraud around that. But both initial claims and continuing claims came down today. So I think, yields certainly responded to that, but markets brushed it off due to that selective hearing. Typically, higher yields would put a bit of pressure on risk assets, but all that markets need to know right now is that the Fed is loosening financial conditions, and that's enough.
Let me ask you, in terms of how you characterize the equity market, Emily, I like this. You say it is on the most epic honeymoon ever. Walk me through that. And I guess I'm also curious, Emily, how do you think, how and when that honeymoon might end?
Yeah, it's really back to the honeymoon phase with these Fed cuts coming through, but not being more sinister to reflect a really deteriorating labor market, and it's reflected in valuations. The S&P 500 right now is trading at 22 and a half times forward earnings. The most expensive they've ever been in the late 90s was 24 times. So we're certainly getting up there, and we've got double-digit earnings estimates for 2026 based in to those PE ratios. So that's going to be tricky. We also have high yield bond spreads at a remarkable 268 basis points. That is a sign that credit markets are saying there is nothing to see here. So I think, it's just a difficult starting point for equity markets at these valuations. It doesn't mean we're not finding opportunities. We certainly are. We'd like the earnings growth in the United States into next year, but we do have a bit of a valuation issue here. Bonds, on the other hand, are really not sniffing out the disinflation and lower growth that we see coming into next year. And we think that's an area that investors should consider adding to positions.
So in the equity market, Emily, you are seeing some opportunity. Where is the opportunity, Emily? How do I want to be positioned? What sectors do I want to overweight, in your opinion?
Yeah, so we're focused on quality right now. So we want to identify companies that have great balance sheets, good return on equity, great earnings growth prospects into next year. But we want to be careful about overpaying for that earnings growth. So we're looking at, not to get too in the weeds here, but something called the PEG ratio. I'm sure many of your listeners are familiar with it. It's the PE ratio divided by earnings growth. It's essentially a measure of how much you're paying for future earnings growth. And the lower the better, just like golf. And we're finding that in sectors like communication services, technology, and the industrial sector as well, looking into next year.
What sectors are you less enthusiastic about here, Emily? What looks relatively less attractive?
So we're trimming into strength and momentum. I mean, technicals and momentum have really been driving these markets, and we're seeing it particularly in areas like China, which is up over 40% year to date on 0% earnings growth. Europe has been a technical titan, and it's been helped a lot by the weaker dollar and the strength in the euro. European equities up about 25% on very, very minimal earnings growth this year as well. So we're looking to trim into some of those momentum, technically driven pockets of the market and into the United States, where frankly, we're seeing better relative economic growth and better relative earnings growth.
Emily, always great to see you. Thank you.
Thank you.
Stay with us. More Market Domination Overtime coming right up. FedEx reporting its first quarter results and taking a look now at the numbers. So Q1 adjusted EPS, $3.83. The street was at $3.59. Q1 revenue, $22.2 billion versus estimates of $21.67 billion. So beats there on the bottom and the top. Q1 adjusted operating margins, 5.8%. That's also better. Looks like the estimate was 5.62%. Also, importantly, FedEx does reinstate its full-year profit outlook. Investors are going to appreciate that. So they see full-year adjusted EPS between 17.20 to 19. Looks like the estimate was at 18.25. Stock higher here, about 6% in the after hours. Of course, it's been rougher year to date. Heading into this print, the stock was down about 20% this year heading into the print. Despite that, or maybe in part because of it, most analysts on the street tell their clients they think this one is a buy here. The average target, by the way, in the street per Bloomberg is around 261. Investors are going to have plenty of questions on the call, of course. Delivery volumes, consumer and business trends, tariff impact, also the end of the de minimis exemption. That would all be front and center. But at least initially here, nice pop in the after hours for FedEx, up more than 5% here. And from FedEx to Amex, the Platinum card is getting a major update along with a hefty new annual fee. For more, we're bringing in Yahoo Finance senior writer Ben Walker. Ben, walk us through it.
Hey, how's it going? Thanks for having me. Yeah, so the Amex Platinum has just gotten a major refresh, and this is a super popular card for people who like travel credit cards. Some of the new benefits are really standouts, and I think they can provide a lot of value to Amex Platinum card holders who are looking to offset that new hefty annual fee, like you said. Before I go any further, though, I do want to say that a lot of these benefits require you to enroll in them before you can use them. So it's important to go into your online account and enroll in these benefits. But the first standout credit I want to mention is that you can receive up to $600 in hotel credit each year. So that's up to $300 twice a year on eligible fine hotels and resorts or the hotel collection bookings made through Amex Travel. So if you have upcoming trips, this benefit can help cover some of your lodging expenses. The next credit is up to $400 in Resi credit. So that's up to $100 per quarter on eligible Resi purchases. Now, Resi is a restaurant reservation platform, but you don't actually have to make any reservations through Resi to use this credit. All you have to do is enroll in the benefit and then use your Amex Platinum card for a dining purchase at a Resi restaurant. The last standout credit I want to mention is you can receive up to $300 in digital entertainment credit per year. So that's up to $25 per month on eligible streaming services. So if you already use streaming services like Disney Plus, including Disney Plus bundles, Peacock, Paramount Plus, YouTube TV, and others, this should be an easy credit to use. And with these 3 credits alone, that's over $1,300 in value. And that's without mentioning many other available credits and benefits, which can provide you with an additional $1,400 or more in value.
So Ben, bottom line, my friend, is it worth it, in your opinion?
Yeah, I mean, $895 is a lot of money. That's one of the biggest annual fees around on any of these credit cards. But for many people, this annual fee, I think, is going to be more than worth paying. If the benefits align with your lifestyle and spending habits, you can get over $3,500 in potential annual value. But, I will say it's not going to make sense for everyone. If you find that you would have to put in a lot of effort to get value from these benefits and credits, like maybe you don't use these services that often, it may not be worth it for you on a long-term basis.
Ben, thank you. Appreciate it.
Thank you.
Well, the Fed has started easing rates, and our executive editor, Brian Sozzi, sat down with IBM's vice chair during Yahoo Finance's opening bid for more on the Fed's balancing of risks.
The chair admitted he's got a problem. He's in a conundrum. He's got a 2-factor model. Factor number 1 is stable prices, which is basically a goal of 2% inflation. He's not achieving that. He's higher than 2% inflation. On the other hand, he's got a factor 2, which is full employment. He sees very clearly that the employment market is softening. The data has come in very soft. We're seeing 50,000, 25,000 new jobs created each month. So the chairman's sitting there going, look, I'm trying to balance these 2 parts of the equation. Which one matters to me more today, knowing that if I fix one, I may affect the other. And he sort of admitted that yesterday. So he pivoted yesterday and said, I'm going to deal with the employment problem in the United States. We're going to cut interest rates by 25 basis points. We're going to sort of dip our toe in the water. He actually called it a risk management exercise.
It's clever. That's what stuck that in there. Yeah.
Risk management exercise. We're going to cut 25 basis points, and we're going to see if we can help job growth in this country, knowing that cutting interest rates is stimulative to the inflationary side of the economy. So he's in there admitting he's got this problem, he's got this conundrum. His committee as a whole, he's got a committee that votes as a whole, really had a pretty interesting divergence of where they think interest rates are going and where they are. You literally had one person on the committee that, even though it seems like they voted for this cut, in their projection of where they think interest rates would be, they did not have this cut in their projection. Then you had 6 more that said, we don't need any more cuts for the rest of the year. Then you had 9 that said, we need 2 cuts for the rest of the year. Yeah. So even just looking out between now and year end, the chair's got to balance a committee that understands they're trying to deal with this 2-factor model. It does look like we have started a rate cutting path, but it seems like it's going to be a slow, methodical path, and it's not a guaranteed path. So, if you look at where the dots plot out to the year end, it's about 3.6%, which is about 2 2/3 of a cut. So it looks like one more is baked in for sure, and maybe 2.
Every time the Fed chair mentioned the labor market, I'm like, wow, the jobs market's going to stink. And it's going to get worse. But does that reinforce the point we've heard from President Trump that this is too late, Jay?
I don't know if it's too late, Jay. The job market has clearly been softening over the last few months. On the other hand, the inflation numbers have not come down as fast as the chair would want. Now they've come down, but they're still stuck. Core's still stuck around 3%, 2.9%, and his target is to get it to 2%. So look, you can criticize any part of this whole equation you want. You can criticize that the chair is late because the job market has gotten soft. You could criticize because he's being too aggressive because inflation's too high. Like I said, it's a 2-factor model he's trying to balance out.
You will not hear Powell say this, but did he bend to pressure from the administration?
I don't think so. At the end of the day, I don't think he bent. In fact, if you look at the committee, there was one dissenting vote. The entire committee.
Stephen Myron.
Yeah.
Right, yeah. New guy.
Yeah, the new guy. The entire committee voted for this cut, and there was one dissenter. It's funny, in the meeting prior to this, there were more dissenters than there were in this meeting. So it actually looks like the chair has brought the committee together. It's more cohesive. They've got a methodical plan that they're on right now of this slow but steady potential cutting cycle.
How worried are you that we do see a deeper economic downturn at the same time the Fed is cutting rates?
There's always the potential of a deep economic downturn. That's part of the economy. We have events that we don't see coming, and we always get caught off guard because we don't see them coming. So, we have these quote unquote black swan events. if they were white swans, we'd know they were coming. Yeah. So look, we're always worried about events like that, and usually there's some cause that happens, some exogenous event that happens. As I sit here today, I don't see anything. But I would have given that same answer a month before a couple major financial crises, that the world looks good today, I don't see anything. And after these events happen, they look pretty obvious. To me right now, we're in an environment where the equity market's at record highs, credit spreads are all-time tights. Look, the dollar's weakening pretty considerably, but nothing looks too out of line right now.
You're a plugged-in guy. Do you think we get a Fed chair announcement before year end, and who do you think gets his job?
Oh, I have no idea when it gets announced. I really don't.
Is there someone you think that would be best suited to get this job?
No, look, I think the president has a good list of candidates. There's some people that are very, very qualified, very highly qualified, and I think we'd be lucky to have them.
Of course, we were talking about a little bit about tech off camera. This is an interesting time to tech. We saw the Nvidia Intel news. Is this a good thing to see these tie-ups like this?
Well, there's some good in this, always. Look, the United States, as we know, has to become a chip manufacturer. We cannot be dependent on the rest of the world for chips. Look, we came out of COVID understanding the supply chain better than we ever did before. We understood that without chips being imported to the United States, our economy, our manufacturing economy, shut down. you literally could not buy most of the things that we want in this country. Even simple things as toasters today somehow have to have chips.
Well, you got to connect to your phone, Gary. I need to know when my toast is done.
I guess you have to hit your phone in bed to put the toast down in the morning.
Yes.
So you can do that. So look, we now are in an economy where everything we buy has a chip in it. We can't be beholden to the rest of the world. So to the extent that the federal government is getting involved in encouraging chip manufacturing in the United States, and this started in the last administration with the CHIPS Act, and we continue to press on this independence of vital necessity goods in this country, I do think is a good thing.
Do you view it as the administration picking winners and losers?
I hope the administration's not picking winners and losers. It's not their job to pick winners and losers. What it is the federal government's job is to protect the citizens, protect our safety, protect our well-being, and we know that chips are a vital part of protecting our country. You know, simple missiles today have 300 plus chips in them. So to be able to defend ourselves, to be able to build military equipment, we need to be in the chip manufacturing business here. So that I do applaud, that we understand the risk of not having chip manufacturing in the United States.
IBM investing just billions of dollars in AI and its own infrastructure. Where do you think we are in the AI CapEx build-out?
You know, look, it's the AI CapEx build is pretty transparent. There's an enormous amount of money being spent in data centers. These data centers will come on sort of over the next 3 to 4 to 5 years. You will continue to see more and more use of AI. What's going on right now is, you know, people are using AI, but they're using sort of independent software, independent programs to solve a specific AI problem.
Like an agent.
Yeah, like an agent. So
do my payroll.
Oh, do my payroll. Handle my HR. Read my documents. Help me with my tax return. Help me with my tax returns. Where I believe this is going, where IBM believes this is going to an enterprise-wide solution, where all of these AI programs, these AI facilities will work together. They'll be more coherently, more cohesively related, and they'll have a big infrastructure behind that. And look, that's going to lead us into a really interesting world as people get their data and databases in a more coherent place, and that's what it takes to make AI work. It's going to lead us into a quantum revolution. We think by the end of this decade, we're going to have quantum, be a major part of this equation.
That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Don't go anywhere. On the other side of the break, it's Asking for a Trend. We've got you covered for the next half hour with the latest and greatest market-moving stories so you get ahead of the themes affecting your money.